The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So, we're going to be talking about money today. We're going to be talking about the impact of an executive order that the president has signed. We're going to be talking about fees. We're going to be talking about a number of things today. I've got a couple guests that you want to hear about. But before we get there, I want to tell you about an event that's coming up on March 25th. It's called Play It Forward. It's going to be Play It Forward 7. It's an event which raises money for high school music programs in those schools where the parents usually don't have money. Now, for a long time, I lived on Mercer Island. I've lived in other school districts where if there was a shortfall in the music program or the sports program or the debate team or one of the others, the parents would step up and write a check. But if you live in Ritzville, or if you live in Omak, or you live in one of the other small towns around, parents don't have the capability to do that. And what this does is it raises money for those programs. One example, there's a teacher close to Yelm, in a school district close to Yelm, whose classroom was destroyed in the Nisqually earthquake back in 2001. It's been in disrepair since then for over 10 years, for over a decade. Her time was cut back to half time, and she was using her salary, the limited salary that she had, to buy instruments for the students to put them through the music program in that school. Music Aid Northwest came forward with a grant for $5,000, and the provision in the grant says that it can't replace other money. It has to be supplemental to anything else. And the school principal, the school superintendent have to be involved. And we suggest that they add at least 10% to that grant. In this case, they said, gee, the classroom's been damaged back since 2001 in that earthquake. We should get that repaired. She was teaching in a portable for the last over 10 years. We should get the classroom repaired, and we should probably increase her to 0.9. So that $5,000 grant resulted in almost an $80,000 supplement. That's what this program is for. Not only that, it's a very fun event because there's no auction at the event. It's just fun. This year's theme is the Rock and Roll Hall of Fame. It's going to focus on Alan White, and his band. White is going to play. Alan White, you may remember, is the drummer for Yes. He's being inducted into the Hall of Fame in April. If you come to this event, you'll be able to meet him before he's inducted into the Hall of Fame. And if you've been around a while, you probably remember the song Imagine, John Lennon's song. Alan White was the drummer on that. He was the drummer on Instant Karma. He's going to be there. So are two members of Heart, also Hall of Famers. It's a very fun time, no auction. And if you want to go, the tickets are $250 and $500. Contact me, 206-903-1019, or send me an email at mike@adamsfinancialconcepts.com. Do this. It's a great time. I've done a number of galas, a number of events over 20-some years, 30 years. This is the most fun I've ever had last year. So do this. It's a great cause, and it's a lot of fun. So, shifting gears, the executive order. Just signed this last week. President Trump signed an executive order concerning the Department of Labor Fiduciary Rule. It's been a controversial rule. It's been very controversial. The big brokerage houses, the big banks, the insurance companies have all fought strongly against it. It went into effect, and there's reasons why it went into effect. You know that I've been for the rule, but we'll get there. I want to talk about the background first. How did we get there in the first place? President Obama, when he was president, had a study done on 401ks, IRAs, and what was happening in that area. There's 72 million participants in 401ks. There's 483,000 plans that are out there. And the issues were these. 54% of U.S. workers, 54% of those 72 million, had less than $25,000 in retirement savings. 27%, half of those, had less than $1,000 in savings. Plan participants, fewer than 75% of those who were eligible were participating in their 401ks. And the average balance for those who were retiring after 30 years, think about it, 30 years, the average balance was $144,000. That's enough money for retirement supplement of about $400 a month, maybe not even that. That's the issue. When we had defined benefit plans, when people work for a company and they got a portion of their salary, that was all set aside by the company. But with the 401k, people had control of their own money. They could invest it as they wanted to. But there was something else that was going on. Those plans have been very, very profitable for Wall Street, for the big banks, for the big brokerage houses, for the big insurance companies. The Obama study showed that annually, those plans for Wall Street were creating $17 billion. That's a pretty good chunk of money. You can begin to understand why the banks and the insurance companies and the brokerage houses did not want to see the DOL rule go into effect. In 2008, or actually before 2008, there was a study done by the Department of Labor that found there were up to 17 different fees that were being charged to those plans, and most of those fees were hidden fees. People didn't even know they were paying it. And what that means is if the returns, if the fees are an additional 1%, that takes away, after 25 years, that reduces the retirement sum of money by 17%. 1% doesn't seem like much, but it reduced it by 17%. Think about what 2 or 3 or 4% does. People were paying half of what 401ks returned to Wall Street. It was not a very good situation. And when the Department of Labor looked at it in 2008, they found that 77% of plans were out of compliance. And the Department of Labor hired an additional group of enforcement agents. They went from 100 to 1,000. And the fines for those out of compliance plans were running, the fines and restitution were running over $1 billion a year. So the proposal was to institute a fiduciary rule. A fiduciary rule means that all decisions are made in the best interest of the participant, the best interest of those who were contributing to their 401k, not in the best interest of the banks, the brokerage houses, and the insurance companies. That has been very, very controversial. I don't know what the numbers were for the Department of Labor rule. I know that for the Volcker rule, which was part of the Dodd-Frank, the number of letters that came in supporting the Volcker rule were well over 30,000. But the number of in-person meetings were less than 50. On the other hand, the number of in-person meetings by the big banks, brokerage houses, and insurance companies against the Volcker rule, the number of letters was about 100, and the number of in-person visits was 700. The Volcker rule only passed because of the big whale problem that Chase had with the big whale who lost $7 or $8 billion in trading in London within a very short period of time. I think that the same thing was true of the Department of Labor law or rule, the fiduciary rule, that the number of supporters, the number of people that wrote letters supporting the rule, way outnumbered the number of letters that came from those who opposed it, but those who opposed it were the ones who were contributing to congressmen, contributing to senators, who were contributing to presidential campaigns. And in the beginning, I was really hopeful when our current president, when he was running for office, I was really hopeful because he talked about Wall Street and taking away Wall Street's power. But that hopefulness went away when we began to get the appointment of his Treasury Secretary, of his financial advisors, of his economic advisors, many coming from Goldman Sachs, coming from the banks, coming from the insurance companies. And now you can see the executive order which went into effect. And it's not going to be an easy thing to do away with, because regulations that are passed by agencies, and there's more laws that are passed by agencies than are passed by Congress. Big issue about that. I understand the issue. I think that Congress should be passing the regulations and the laws, but agencies pass these like the Department of Labor. They go through a whole process, so it's not easy for a president to suddenly say, we're going to do away with it. But there are things that he can and will do, and he started that. Don't go away. We'll talk about what actually he did and the impact.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Concluding loss of principal.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So, I've been talking about the fiduciary rule and the new executive order that was signed by President Trump about the fiduciary rule. Talked about the background. 72 million people have 401ks, 483,000 plans. The average worker has, or 54% of the workers have less than 25,000. 27% of the workers have less than 1,000. The average amount that people are retiring on after 30 years is 144,000. Not a very good situation. And the difference, a lot of the difference is going into the pockets of big brokerage houses, banks, and insurance companies, or has been, and would continue to be if we put in, or would be stopped if the Department of Labor fiduciary rule went into effect. The fiduciary rule says that, essentially says, every decision has to be made in the best interest of the participants. But the new executive order signed says it's signed for 4 things specifically. It's to conduct an updated economic and legal analysis of harm to investors, and is there a reduction in advice to the participants in the plan? That's the first thing. Secondly, does it result in dislocations or disruptions that adversely affect investors and retirees? Thirdly, will the rule cause an increase in litigation? And fourthly, will it increase the price investors will have to pay for their 401ks and investments? But we already know probably the results they're going to find from that study. It's pretty obvious from the way it was written. Will there be a reduction in advice? That's one of the big arguments that the banks and the brokerage houses and the insurance companies made. They said, if every decision has to be made in the best interest of the client, that's going to result in a reduction of advice. I have a little hard time understanding that logic, that if everything is made in the best decision of the participants, of the investors, of the retirees, how that's going to reduce advice. But the thing is, they're worried about the third point in litigation. I have to tell a story. I met with a person this last week. He had gone to a financial advisor. He had lost his job in 2008 or 2009. They were upside down in their house. They lost the house. His wife is on disability. He had $350,000 or $325,000 or thereabouts in his 401k. So he took the 401k and he went to a seminar on how to maximize Social Security. And during that seminar, the financial advisor said, we also do financial planning. So he went to the financial advisor to do the financial planning. And the result was he advised the person to put $128,000 into an annuity in his IRA. So an IRA is already tax deferred. Annuity is tax deferred. There's almost no reason, in my opinion, to do an annuity inside an IRA, except in the interest of the financial advisor, because the financial advisor probably got an 8% payout on that. Secondly, he advised him to make an investment with the rest of the money, $200,000, and this is all the money these people have, $325,000 roughly, an investment in a company that was paying 12 to 13% because they were investing in Brazilian factored paper. Now, factored paper is taking accounts receivable, paying lower amounts for the accounts receivable, and collecting the difference. Now, accounts receivable are when you buy something and don't pay for it immediately, you owe the company money. Now, the companies that sell their accounts receivable are companies already in a cash flow problem, already in a bind. So there's a significant high risk. So the getting a 12 to 13% payout was pretty large for the investor, but the financial advisor was getting paid 6%. And there was a supervisor who was in charge of all the other advisors who was getting a 3% override. So the financial advisors were taking 9% per year out of this. Is it any wonder that that firm filed for bankruptcy? They raised $64 million from 40 investors. Their net assets when they filed for bankruptcy were $50,000. Tragic. That is not making every decision in the best interest of the client. Not at all. That's horrible. But the question is, will that reduce the amount of advice that clients hear? I think the advice will be better, even if it's less. But I don't think there'll be any less advice. But you know what? They didn't call me and ask my opinion. The second thing is it going to cause disruptions in the market? And you bet it's going to cause disruptions. There's a lot of people who are not giving great advice. There are a lot of people who are looking at putting things like the annuity that was put in that person's account. The financial advisor made 8%, $10,000 or so. It was not to the benefit of the person who invested the money, the client who invested the money, because that annuity was capped at 7%, and the insurance company was taking 2.9% of the 7. So the most they could make was 4.1%. That's tragic. But the financial advisor got 8% or so. So will it make dislocations? I believe it will, and I believe all those dislocations are in the advantage of the clients, not the financial advisors and not the banks, brokerage houses, or insurance companies. The third point is, will it increase litigation? and I'm sure it will. Because if decisions are not made in the best interest of the client, people can and will sue. And will it increase the price? I don't think so. I think that's the weakest part of all. That doesn't mean that the insurance company, brokerage houses, and banks won't say that we're going to have to increase our price to meet. But I believe that over the long run, that's not going to happen. That's the fiduciary rule. Things have changed. Things are changing. It's, in my opinion, very sad because we're going to go back to what we had before we had the fiduciary rule. And maybe I'm wrong. Maybe the fiduciary rule will be put into effect. It's supposed to go into effect in April of this year. It's going to be delayed at least 6 months, maybe, until we have a new administration. We'll have to see. In any respect, that means that I will do what the fiduciary rule says. We are a 338 fiduciary. We take that responsibility. We'll continue to take it on our 401ks. We'll continue to make every decision for our clients in their best interest and not in ours, not in anyone else's but theirs. That's the way it has to be. Anyway, that brings me to an end there. I want to introduce you to my guests because they have a great story. Nothing to do with 401ks, nothing to do with fiduciary rules, nothing to do with banks, insurance companies, and brokerage houses. Nothing to do with all that. They're just about fun and games. And so it is. Silver Lining Games, Margaret Marshall and Rachel Kaufman. Did I say that right?
That's right.
Welcome to the program.
Thank you so much for having us.
So why don't we begin with your backgrounds? Let's begin with Margaret, and then we'll get to Rachel.
Absolutely. So I have been in Seattle now for about 17 years, and during that time have had a career that spanned advertising, sales, and marketing, HR in a strange turn of events, and also starting my own game company with my partner Rachel here.
So Rachel, how about you?
So I'm originally from Cincinnati, Ohio. I came to Seattle via Chicago. I was in Chicago for a couple of years working for the parent company of Jim Beam, known at the time as Beam, now known as Beam Suntory. And I came to Seattle for my husband's job with Amazon. I subsequently began working at Amazon and met my lovely friend Margaret, and we started hanging out a lot outside of work, played a lot of games together, and after some work on a women's conference together, thought, hey, why don't we try to make a game? And here we are. We made a game.
You made a game. So tell us about the game.
So the first game we launched, which we hope won't be the last, is a game called Sway, a game of debate and silver linings. And it might be fitting for me to explain what a silver lining is in case those of you don't know. But a silver lining is finding the positive in what on the surface might be negative. It's really like ignoring the rain in a rain cloud and instead just seeing the beautiful silver that it makes the sky. And that's what we designed our game to do, was to focus people and their thoughts and energies on what's positive, even if on the surface it doesn't seem so. So the fundamental core of the gameplay is two players each debate radically different topics that on the surface might not seem positive at all, like getting pooped on by a bird or having a middle airplane seat, all while doing a funny challenge, perhaps speaking in a Scottish accent or speaking in rhymes. And a judge determines the winner, but the point of the game is really less about winning and judgment and more about having fun and seeing the positive in all things.
So you started out, before you started the game, you started out with some basic goals in mind. Why don't we talk a little bit about that before the commercial break, and we're going to come to a commercial break soon, but we'll finish it.
So
after.
One of our primary goals when we started this was really just to see if we could do it, to see if we could, outside of work, come up with something that we felt was a truly marketable product, and really make something that put something positive into the world. We talked a lot at the beginning about how we wanted to put something beautiful and joyful into the world. So, one, can we do it? Two, can we do something that actually put something good into the world, not just something that the sole purpose is making money? Of course, we hope we make some money too, but
of course.
those are our two primary goals, and lots of others, but
And that's what drove our mission statement, which is creating joy and expression through card games.
Hang on, those thoughts, because we're going to come back right after this commercial break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Get away. Get a good job with the pen, you're okay.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Rachel Coffin and Margaret Marshall of Silver Lining Games. We're just talking about their philosophy, their goals, their core values. So let's return there and talk about that, because I think that's very fascinating.
Yes, we were talking a little bit about how creating games that bring joy into the world is really our primary goal. We both played a lot of games and enjoyed the competitive aspects of them, enjoyed games like Cards Against Humanity, but found that there weren't, for some of our friends who don't play games all the time, there weren't a ton of options that felt accessible to them. So that was one of the first things that we wanted to do, is create a game that really anybody could play and have a good time playing. We also wanted to put something out there that we could play with family and friends alike, which is not always the same scenario. If you've ever played games at a family gathering, you're going to pick a very different kind of game probably than you would at a party with friends. And a lot of party games, like Cards Against Humanity and, Taboo and things like that, work really well in a family gathering, and some don't work very well. So we knew we wanted something that would work in a family gathering so we could play with anybody that we liked.
We also had noticed a trend in the gaming industry, specifically within party games, that the humor in games often came from the game itself, the game content, what was on the cards or in the game box. And we really enjoy games like that, but we also like games that challenge our intelligence in a bit of a different way. And so that's what we strove to create, and believe we have created with Sway, is a game that is funny in a different way every time you play, even if you're playing the same card that you've seen before, because the humor and the content is coming from the player's mind and creativity. Seeing different people play the card, talking about why pineapple is great, can be taken a lot of different angles, and every time it gets a laugh in a different way.
Seems like a lot of fun. But let's go back. Now we know about the game. Let's talk about how you got to the game. What was the process? You had this idea, you started to put it together. What happened from there?
We actually started with a list of about 10 ideas. When I had proposed to Rachel starting a game company, that very first meeting, I said, here's a list of starter ideas. And to be frank, Sway was not on that list. It took us some time to really work through various concepts and ideas, and landed on a couple that we took to early prototype phases. And when we played Sway, the very first play was handwritten note cards that we just played with a group of friends one night, and the uproarious laughter that it created, and the fact that it was the type of game that you really could move faster to market with, because it was a card-based party game, so less game elements and easier to play test. The laughter and the reaction combined with that speed to market ability is what made us land on Sway.
Yeah, we, to Margaret's point, made a couple of prototypes. There was a game that had a map involved and would need a board and would need all these different pieces and elements, and we were struggling to come up with how that, when we were trying to prototype it, how that was all going to work. And we got a little frustrated, and I said, there's this other idea we talked about that there's just a kernel of an idea. What if we try to prototype that for a minute? Let's just take a break from this and see how that goes. And as Margaret said, we played it that night. It went really well, but it wasn't a fully formed idea. You don't go into this with knowing every element. So it was literally just topics, and we just debated back and forth why the topic was good. We didn't have the element of challenges. We didn't have the element of randomizing who you're going to go up against and who your judge is. And the challenges actually are probably the most popular part of the game. And that we didn't add to the game for, I don't know, probably it was at least the third prototype before we got to challenges. And without challenges, I do not think our game would be anywhere near as fun as it is. And we came up with challenges actually after a conversation with Whit Alexander, who is one of the creators of Cranium, who happens to live here in Seattle. We did not know Whit before we started this company. Margaret, being the bold person that she is, just sent him a message on LinkedIn and asked if he would be willing to talk to two aspiring game makers, and he said yes. So we went and had some coffee with Whit, and he gave us some advice about game design, one of which was you want to have multiple elements in a game that allow people to engage with it. So if they're not good at one aspect of the game, you want to give them something else that they might be good at. So maybe I'm not the best at making an argument about why, burning dinner is a positive thing, but I am really great at doing yoga poses and being silly. So I can be good at the challenges while other people are great at the debate aspect of the game. And that was a really fun part of the process, but I've been throughout you kind of asked, how did we come up with this? How did we come to where we are with the game? We've had a lot of experiences that surprised me in terms of people's generosity with their time, their advice, their willingness to talk to people who, frankly, we did not know what we were doing when we got into this. And that has been really, really wonderful to experience that kind of generosity and kindness from people here in the Seattle gaming community.
We'll come back to that in a second. But you came up with the idea, and then you had to fund it. And what did you do to fund it?
Yeah, we decided to pursue a path that's ever increasing in popularity, I would say, which is crowdfunding. So we, in September of 2015, we took our idea to Kickstarter, and we did it at an earlier stage than many companies choose to, where the idea wasn't, it was quite formed, but we were still working out the bits and pieces of the game elements, the rules, etc. And so the good thing about that is that we were able to test the idea in the market, and that test was, could we successfully fund a Kickstarter, which we did. And then after we had that increased level of confidence and that check of market viability, we continued to go through the process of playtesting, refining the game elements that enabled us to actually bring the game to market, which didn't happen until almost 9 months later, or really, gosh, even longer than that. It was August of 2016, this year, when we actually took the game to market using that startup capital that Kickstarter infused into the business and added to startup capital that we were fortunate enough to be able to put in as well.
Estimates, by the way, about crowdfunding is that by 2020, crowdfunding will raise $300 billion a year.
Wow.
It's significant. You're one of several that have been on the program that have raised money through Kickstarter or GoFundMe or one of the others, or strictly crowdfunding. So it's the new venture capital.
Yeah, absolutely.
Anyway, so once you got funded, you went to Amazon as well.
Yes, so Amazon was our entry point into the marketplace, and it was really advantageous. In fact, it was surprising to me, although perhaps it shouldn't have been, especially since Rachel and I both have experience working at Amazon. But what a huge difference that made for a company like us that were starting with no market, no audience outside of the limited audience we expanded on Kickstarter, and to be able to leverage an e-commerce platform like Amazon into taking us from nothing to a point where we're a viable business and are able now to take the capital that we have continued to grow through that endeavor and reinvest it into the company to grow and expand. And in part that was done through a program called Amazon Launchpad, which specifically caters to companies that have funded through either venture capital or crowdfunding, and helps give them additional marketing support, additional exposure on the site, much like a large company might receive, but even for us tiny guys out here. And you'll notice on the product page on Amazon, you can see really clearly the difference, where it allows us a forum to tell our story, the story of our game, the story of us as entrepreneurs. And that has definitely been a lot of added value as we're getting off the ground.
Yeah, the other thing that Launchpad has allowed us, as Margaret kind of alluded to, is access to promotional opportunities that we may not otherwise have access to through Amazon. Because Launchpad is its sort of own self-contained store, if you will, on Amazon, they have sort of feature pages that show all the different categories of Launchpad products. If somebody wants to specifically seek out a sort of startup product, they can do that. They did something called Startup Week this year that I believe was their first year doing it, and they had a lot of success with it. They did it the first week of November, and so in order to participate, all we had to do was say, yeah, we're willing to take an X percentage price reduction. I can't even remember what it was, but it was a couple of bucks to us. It was very minimal what we had to do as far as the bar of entry for that. And when we signed up for it, we didn't have any idea what kind of impact it was going to have. The homepage for Startup Week had several different features. We were not one of the top features. We were just in a little bar. And we didn't think that would make much of a difference. But that week, our sales quadrupled or something like that, and continued. That momentum put us higher in search rankings, put us higher in the larger toys category. It makes it easier for customers to find us. So there's all these things that happen in the background with Amazon that we have access to because of Launchpad that we almost definitely would not have access to as a third-party seller on Amazon. And that's been fascinating to see how those little things that don't seem like they have much value end up having a huge impact on our business because Amazon is as large as it is.
So again, tell us about the name of the game. Tell us where people can find it and buy it.
Absolutely.
So as we come to the end of this time.
Perfect. And thank you again for this time. But the game is Sway, a game of debate and silver linings. It is available on Amazon. If you search Sway or Sway Game, it'll pop right up there. We also have a website.
It's playsway.com.
And yeah, we hope everybody checks it out.
I will for sure. Anyway, thanks for being on the program. Don't go away. We're coming to a commercial break, and I want to talk about fees. So don't go away.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So welcome back. We're going to be talking about fees, but it's the beginning of baseball season. And if you listen to me, you know that I love baseball. It's math. I'm a mathematician. I like baseball. I'm always reminded about what Tommy Lasorda said. Tommy Lasorda was the longtime manager of the Los Angeles Dodgers. And he said to his wife, "You know, I do love you more than football." I always remember that. Baseball becomes an all-consuming sport. But there's some analogies with investing and fees, I think, at least. You don't pay the same amount to an utility infielder who's hitting 220 as you do to a Ken Griffey Jr. who hits the 5th most home runs in the game. Hits 50 home runs, hits 58 home runs, I think, in 95. You don't pay the same amount to a utility player as you do to a superstar. And I'm not saying I'm a superstar. And yet, Eugene Fama, when he shared the Nobel Prize in 2013, his study showed fewer than 3% of money managers earn their fees. That means they equaled when you took their net results, net of all fees and cost and commissions, 3% were equaling the market. Only 3%. I think it's a larger number than that. I think his study didn't expand enough, but that was Fama. There's been a number of other studies that have shown similar kinds of things, that fewer than 10% of money managers over the long term have been able to equal the Standard & Poor's 500. That says something. And I've been able to do that for the most part. Not for the most part. I've been able to do that for a long time. If you look on my website, you'll find that my returns are actually posted. Those are composite returns. Those are all my clients that are equity investors, stock buyers. Those are the accounts that I manage. And prior to that, when I worked for large brokerage firms, which I did for 18 years, I had what I called hypothetical. I did keep track of my returns. And the way that I got into this whole thing, I licensed in 1986. And in 1986, I was a stock jockey. I was like most stockbrokers. We would buy a stock, we would write it up, we would sell it, because you got paid by the commissions that were generated. If you didn't buy and sell, you didn't make any money. So the idea was to get into a position, buy a stock, write it up, or sometimes down, sell the stock, and move on to another. I can remember in those early days, I would spend a full month talking to people, and I did cold call. I talked to people about buying a stock, and then the next month I would talk about a different stock, and the next month a different stock, next month a different stock. But when a stock got to a certain price and I sold it, all of that money came out of those stocks into the current stock that I was selling. So I built big positions. That was the way that it was working. But I ran into a stock that I didn't really want to sell. It met my price target. I couldn't sell it. I began to realize I was getting paid for buying and selling, but there were times when I thought that I would prefer to get paid for keeping people in a stock rather than selling it, because I wanted to ride a stock all the way up. And there have been those that have done extremely well. You can name a lot of them. If you're in the stock market, you can name a lot of stocks from this local area that have done extremely well over the years. Those are the kinds of things that got me to the point that I said, I want to be a manager of investments, investment manager, rather than a stock jockey. And so, beginning at the end of 1990, the first account that I opened was on December 31st of 1990. I began to manage for a fee. And back in those days, there were only a very few of us that were actually managing for a fee, because you made a lot less money than you could being a stock jockey. And the fees at that time, this whole thing was new, was a 3% fee for the first $250,000 or $500,000, 2.5% for the next $500,000, 2% on the next $1 million, and 1.75 for everything over that. And usually the minimum fee was around $600 or $900 or in that range. So you had to have some assets for it to work. That's been my fee structure, actually, almost exactly my fee structure from 1991 until today. 3% for the first 500,000, 2.25% for the next 500,000, 2% for the next million, and 1.75% for everything over 2 million. I've held that for a long time. Now, if you look at where fees are for financial advisors in this whole field of getting paid a fee for the assets under management has taken off. I think over 50% or 60% of accounts now are based on fees, and maybe it's even larger than that now. And the fees have gone into a compression. Average fees now are running at about 1%, 1.02, 1.04%. What that means, in my opinion, is you're getting a utility infielder when you're paying 1%. And not only what I feel, but studies have been done. Dalbar did a study. They've been tracking mutual fund investors. And a lot of people who are charging fees are also investing in mutual funds. But it's indicative of what goes on in my industry. They've been tracking mutual fund investors, and the average person who invested $100,000 30 years ago would have seen that $100,000 grow to $280,000. Now, somebody may be really pleased to have seen their money triple in 30 years. But the reality is, if somebody would have done as well as the market, and that means the ups and downs, the 87s, the 89s, the 2008, 2009, if somebody would have done just what the market did, they wouldn't have 280,000. They'd have 2.1 million. There's an enormous difference. And for me, the person who does the 280,000 is only worth the 1%. And there's reasons I believe that happens. My whole focus is doing my own research. My whole focus has been focusing on producing outstanding results. Even in the papers that I file with regulators, I state very clearly that my goal for my clients is to beat the benchmark, to beat the Standard & Poor's 500. There's not many people that can do that. There's not many people that can do that. But I believe that that's the real value that's delivered, and that's why my fees are what they are. There's advice that I give to my clients, but the primary thing is the performance. And I believe that's the value that I bring, that we bring at Adams Financial Concepts. And we bring it for 401ks, we bring it for individual and a corporate account as well. That, I think, is what makes sense. And that's in the best interest of the client. That's in the best interest of everyone combined. And yes, it's very profitable for me, but it's very profitable for my clients. And I have a very high client loyalty. One of the big issues in the industry is children normally move their accounts when their parents die. That has not happened to me. I have children who move their accounts into me after they see how well their parents have done. Anyway, I don't usually talk about myself, but it seems appropriate to talk about fees. Have a very wonderful weekend, a very wonderful week, and I'll be back next week to talk about money. Join me then.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's Adams Financial Concepts.